Hi, and welcome back. Today, let's discuss transaction costs and their treatment when recognizing and measuring financial instruments. Transaction costs are the direct costs associated with acquiring or issuing a financial asset or liability. These include fees or commissions paid to agents, brokers, advisors, and dealers, along with levies from regulatory agencies, security exchanges, and transfer taxes. However, they do not include debt premiums, financing costs, or internal administrative expenses. Now, how are these transaction costs treated for different types of financial instruments? 1. For financial assets not measured at fair value through profit or loss, transaction costs are added to the fair value at initial recognition. For financial liabilities, these costs are deducted from the fair value at initial recognition. 2. For assets at amortized cost, transaction costs are included in the calculation of the instrument's amortized cost. Over time, these costs are amortized through profit or loss using the effective interest method. 3. For assets at fair value through other comprehensive income, FVOCI, transaction costs are included in the changes in fair value. These costs may also be amortized to profit or loss using the effective interest method over the life of the instrument. Let's look at an example. Suppose an entity acquires a financial asset for rupees 100 and pays a rupees 2 purchase commission. Initially, the asset is recognized at rupees 102. The reporting period ends a day later, and the asset's quoted market price is rupees 100. If sold, a rupees 3 commission would apply. At that point, the entity measures the asset at rupees 100 and recognizes a rupees 2 loss in other comprehensive income if the asset is measured at FVOCI. The reporting period ends a day later and the asset's quoted market price is rupees 100. If sold, a rupees 3 commission would apply. At that point, the entity measures the asset at rupees 100 and recognizes a rupees 2 loss in other comprehensive income if the asset is measured at FVOCI. Remember, transaction costs expected to be incurred during the transfer or disposal of a financial instrument are not included in its measurement. By understanding transaction costs, entities can ensure that their financial reporting accurately reflects the true cost of acquiring or issuing financial instruments. Thanks for joining me. See you next time.